What if I told you the next financial crash is already being predicted by signals almost nobody is watching? Because right now, beneath the surface of record stock prices and seemingly strong economic data, five critical indicators are screaming warnings that Wall Street doesn't want you to hear. These aren't the mainstream metrics you see on the evening news. These are the silent indicators, the ones that have predicted every major collapse for decades. And here's what should terrify you. Before the 2008 financial crisis, all five of these signals flashed red 6 to 18 months early. Before the pandemic crash in 2020, they did it again. People ignored them. Institutions dismissed them. And both times the world paid the price. But this time is different. Not because the signals are wrong, but because they're flashing deeper, stranger, and more dangerous than ever before. All five at the same time for months. Stay until the end because what you're about to discover could change everything. And if this matters to you, smash that like button and subscribe. Let's dive in. So what are these five signals that Wall Street doesn't talk about? Number one, the Baltic Dry Index, a measure of global shipping costs that tracks the real demand for raw materials across the world's oceans. Number two, the CEO Confidence Index, a survey that reveals what the people running America's largest companies truly believe about the economy, not what they say on TV. Number three, the inventory to sales ratio. It shows whether goods are piling up in warehouses because nobody's buying. Number four, the truck tonnage index, a measure of how much freight is moving across American highways, the bloodstream of the economy. And number five, the consumer sentiment gap, the distance between how people feel about the economy and what the official data says they should feel. Now, here's why these matter. Some of these indicators have been around since the 1970s. Others are newer, but every single one has a perfect track record. They don't lie, they don't speculate, they just measure reality. And unlike GDP or unemployment numbers that get reported after the damage is done, these signals flash red before the collapse. They're like canaries in the coal mine. When they start dying, you don't wait around to ask why. Let's start with the one that saw 2008 coming 6 months early. The Baltic Dry Index. It's a number most people have never heard of, but it tracks something critical: the cost of shipping raw materials like iron ore, coal, and grain across the world's oceans. Around 80% of all global trade moves by sea. Now let's go back to May 2008. The index hit an all-time high of 11,793. The world economy seemed unstoppable. Demand for raw materials was exploding. Shipping rates were through the roof. But then something strange happened. Over the next 7 months, the Baltic Dry Index collapsed, 94%. It dropped to just 663 by December. Factories stopped ordering materials. Cargo ships sat empty in harbors. The global supply chain was freezing, and this happened before Lehman Brothers collapsed, before the world knew it was in crisis. The oceans knew before Wall Street did. Fast forward to 2020. In the 6 months leading up to March, the Baltic Dry Index dropped 84%. Once again, it was screaming that demand was vanishing, and then the pandemic hit. Markets crashed, but after that, the index surged 1,200% as the world raced to rebuild supply chains. Here's the logic. When economies slow down, factories stop producing. When factories stop producing, they stop ordering raw materials. When they stop ordering, ships have nothing to carry. And when ships sit idle, the Baltic Dry Index collapses. It's like watching all the delivery trucks disappear from your neighborhood. Something is very wrong. But here's where it gets interesting. As of early December 2025, the index has surged to 2,845 points, the highest level in 2 years. It's risen for 15 consecutive days. On the surface, that sounds positive, right? Not so fast. This rally is driven almost entirely by Chinese demand for one specific commodity, high-grade iron ore from new mines. Meanwhile, smaller vessel segments are struggling. It's a narrow, fragile rally that masks broader weakness in global trade. The ships are telling us something. Strength in one corner, weakness everywhere else. The question is whether anyone is listening. But shipping is just the surface. The real warning comes from the people who run the economy, the CEO Confidence Index. It's a monthly survey that asks the leaders of America's largest companies one simple question. How confident are you about the economy over the next 6 to 12 months? And here's why that matters. CEOs don't rely on government data or headlines. They see the real numbers first. They know when orders are slowing. They know when customers are pulling back, long before any of it shows up in official reports. The conference board started tracking this in 2002. When CEO confidence drops below 50, it means more executives are pessimistic than optimistic, and historically, that's been a warning sign. Let's go back to late 2007. The stock market was still climbing, but quietly, CEO confidence started to fall sharply. CEOs were seeing something the market wasn't. The stock market kept rising into mid-2008, but behind the scenes, CEOs were pulling back, freezing hiring, delaying investments, hoarding cash, and then in September 2008, Lehman Brothers collapsed. The market followed. Now here's where 2025 gets complicated. In the fourth quarter, the Conference Board Index fell to 48, below 50. 64% of CEOs expected a mild economic slowdown over the next 12 to 18 months. But then something shifted in November. Chief executives' survey found confidence climbing back up. Only 22% now expect a recession in the next 6 months, down from 62% in April. So which is it? Pessimistic or optimistic? The answer is both. And that's the problem. This whipsaw in confidence signals deep uncertainty. CEOs don't know what's coming. And when leaders are this divided, that itself is a warning. Look at their actions. Only 43% plan to increase their workforce. Capital spending remains cautious. CEOs are saying they're more confident in public, but their plans tell a different story. When the captains start quietly putting on life jackets, maybe it's time to ask why. These are the people who see the numbers before they're reported, and right now they're uncertain. And uncertainty in many ways is worse than pessimism, but CEOs can only see their own companies. The next signal sees the entire economy. And if you're finding this valuable, hit that like button. It helps more people see these warnings. The inventory to sales ratio. It's a simple concept. How much inventory do businesses have compared to how much they're actually selling? The U.S. Census Bureau and the Federal Reserve have tracked this since the 1960s, but it became a critical indicator in the 70s and 80s. And the pattern is clear. Every time this ratio spikes above trend, a recession follows. It happened in 2001, in 2008, in 2015, and in 2020. Here's the logic. When demand slows, products start piling up, warehouses fill, shelves stay stocked, and at first, businesses think it's temporary, maybe just a slow month. But as inventory keeps growing and sales keep falling, reality sets in. They cut production, they lay off workers, and when people lose their jobs, they stop spending, which means even less demand, more inventory, fewer buyers, and eventually no jobs. It's a downward spiral. Now let's go back to the third quarter of 2008. The inventory to sales ratio was at a record low of 0.61. Analysts said that was a good sign. Low inventory means strong demand, right? But then demand collapsed. And over the next 3 quarters, the ratio shot up by 0.11. Goods were piling up everywhere because nobody was buying. The same thing happened in 2020. When the pandemic hit, people stopped shopping. Inventory surged as sales vanished. Warehouses were packed. Stores couldn't move product. The ratio spiked to 1.74 in April that year. And now, as of July 2025, the total business inventory to sales ratio stands at 1.37. That's down slightly from 1.40 a year earlier. But here's what matters. The ratio has been elevated and sticky throughout 2025, especially in retail and auto sectors. Think about your local stores. If they're full of stuff nobody's buying, how long can they keep the lights on? It's like throwing a party and ordering 100 pizzas, but only 10 people show up. Eventually, you stop ordering pizza. The warehouses are screaming what the headlines won't say. Demand is weakening. And when inventory piles up, layoffs aren't far behind. but inventory is just stuff. The next signal measures something even more fundamental: movement. The Truck Tonnage Index. It measures the weight of freight hauled by trucks across America. And this matters because 72.7% of all goods in the United States move by truck, not by train, not by plane, by truck. The American Trucking Associations has tracked this since the 1970s, and it's a leading indicator. When the economy slows, freight volumes drop before GDP does, before unemployment rises, before the headlines catch on. Let's go back to the Great Recession. Truck tonnage started falling sharply in 2008, months before the economy officially entered recession. Factories were ordering less, stores were stocking less, and the trucks knew it first. Then in May 2020, tonnage dropped 9.6% compared to the year before, the steepest decline since the Great Recession. Trucks were sitting idle. Drivers had no loads. It was a clear warning that the economy had frozen. And here's the pattern. Every time truck tonnage falls sharply and stays down for months, a recession follows within 6 to 12 months. The data doesn't lie. Now look at recent data. In October 2025, the ATA Truck Tonnage Index fell 2.1% to 111.9. That's the lowest level since January 2025. Compared to a year earlier, tonnage dropped 1.8%, the largest year-over-year decline of 2025. The freight market remains in what industry insiders are calling a freight recession. It's been choppy and weak throughout 2025. Trucking companies are failing, drivers are losing work, and new truck sales have fallen sharply. When an industry this critical starts contracting, the entire economy feels it. Trucks are the bloodstream of the economy. They carry food to your grocery store, parts to factories, products to warehouses. And when blood stops flowing, the body shuts down. In 2021, trucks couldn't keep up with demand. There weren't enough drivers. Supply chains were overwhelmed. Today, they're sitting idle. The highways are emptier, and that should terrify you. But all of these signals measure what's happening. The final signal measures why. The consumer sentiment gap. This one's different. This one measures psychology, the distance between how people feel about the economy and what the economic data says they should feel. The University of Michigan has been tracking consumer sentiment since 1978. And for decades, there was a strong correlation. When unemployment was low and inflation was stable, people felt good. When the data improved, sentiment improved. It made sense, but something broke. In June 2022, the Michigan Consumer Sentiment Index crashed to 50, the lowest reading in 44 years of tracking, lower than the depths of the 2008 financial crisis, lower than the worst months of the pandemic. And here's the paradox. GDP is growing. Unemployment is near historic lows. Inflation has come down. By every traditional measure, the economy should be doing well, but people don't feel it. And that gap, that disconnect, is dangerous, because here's what matters. People don't spend based on what the data says. They spend based on how they feel. If you feel poorer, you act poorer. You cut back, you save, you delay purchases. And when millions of people do that at once, recession becomes real. It's a self-fulfilling prophecy. Before 2020, consumer sentiment had a 70% correlation with actual consumer spending. When sentiment dropped, spending followed within months. It was one of the most reliable leading indicators we had. So why is there a gap now? 3 reasons. First, cumulative inflation. Yes, inflation is down to 3%, but prices are still 20 to 30% higher than they were in 2019. Your grocery bill didn't go back down. Your rent didn't go back down. People remember what things used to cost, and they're angry. Second, interest rates. Mortgage rates are around 7%. A few years ago, they were 3%. That means the cost of buying a home has more than doubled. Car loans, credit cards, all of it is more expensive. Even if you have a job, borrowing money hurts. Third, political polarization. Depending on which political party you support, you see the economy completely differently. One side thinks it's collapsing. The other thinks it's fine. There's no shared reality anymore. And that division creates uncertainty. Talk to anyone at the grocery store. They'll tell you the economy isn't fine. Wall Street celebrates record profits. Main Street struggles to pay rent. When people feel poor, they act poor. And that's when recessions become real. Now, here's where it gets terrifying. These 5 signals, they're all flashing red at the same time. So let's step back. 5 signals, 5 separate warning systems, all flashing red at the same time. This has only happened twice before, in 2008 and in 2020, and both times the world changed. In 2008, all 5 were screaming. The Baltic Dry Index collapsed 94%. CEO confidence fell below 50, inventories spiked, truck tonnage dropped, consumer sentiment crashed, and then Lehman Brothers fell. In 2020, it happened again. All 5 signals warned us. The Baltic Dry Index plunged 84%. CEO confidence cratered. Inventories surged. Truck tonnage fell 9.6% in 1 month, and then the pandemic hit. Markets froze. Both times, most people ignored the warnings. Now, here's what's different in 2025. All 5 signals are flashing red again, but this time they've been flashing longer. Truck tonnage has been in recession for 2 years. CEO confidence whipsaws between fear and uncertainty. Inventories remain elevated. Consumer sentiment stays near historic lows, and the Baltic Dry Index shows a fragile rally masking broader weakness. Here's the math. 1 signal wrong, maybe 30% chance. 2 signals, harder to dismiss, but all 5 flashing red for months. The odds of error approach 0, but stocks are near all-time highs. How can we be close to a crash? That's exactly what happens before every crash. In 2007, the market climbed even as these signals turned red. It wasn't until mid-2008 that everything collapsed. Central banks pumped money. 2008 had all 5. 2020 had all 5. But this time, they've been screaming longer. Not 1 signal, not 2, all 5, for months. History has seen this convergence twice. Both times the world changed. This is the third. So what do we do? The answer is not fear, it's preparation. You now know about 5 signals most people never hear about. Track them, watch them. They don't lie. What can you do? Keep cash reserves, diversify, avoid new debt, stay informed. And remember, in every collapse, there's rebirth. Those who see it coming are the ones ready to rebuild. If you found this valuable, smash that subscribe button and hit like. Which signal worries you most? Let me know in the comments. For weekly updates on these 5 signals, join my free Telegram. Link below. Reminder, I'm not a financial advisor. This is education, not advice. Do your own research, but the signals are there. They've been right before, and now they're all saying the same thing. The question is, are you listening? Because this time you can't say nobody warned you.